everyone, very good evening. You're watching The Money Show on ET Now. I'm Ubina Kapasi. This is the show where we help you invest, save and spend your money in the right manner, and of course help answer your questions and queries around money, your mutual fund portfolio as well. So let's tell you what we have lined up on today's episode of the show. First up, this is going to be a retiree special. We will be talking about investment options for retired persons, especially as interest rates are at multi-year, multi-decade lows, and this is something that has caused a lot of investors to lose out, because usually a fixed deposit, for example, is the first port of call for these investors. But this time around, of course, with the RBI governor slashing interest rates, your bank FD, your PPF, etc., does not dole out as much of an interest rate as it did earlier. So what are the other options? And of course, since you're a retiree, you may be depending as well on this money for your regular stream of income. So we'll be talking about that today on the first episode of The Money Show, answering your questions and queries as well. Later on the show, we will be getting on board a very special guest, Nitin Bhatnagar of PCI Standard Security Council, in light of all the data breaches and cyber crimes that we've been witnessing, how you can ensure that you conduct your e-banking transactions safely. And finally, we'll be getting you a brief gist of the conversation we had with four very special ladies last week on how entrepreneurship skills can be built in today's Indian women. Like I mentioned, investment option for retirees. With the low interest rate scenario, profitable or good growth options may seem far and few in between. And plus, let's not forget that as a retiree, you want that stream of income as well coming your way. So what are the options? Options available? We'll get you a gist of all of that. Joining me on the show is Lovaii Navlakhi, the MD and CEO of International Money Matters. Mr. Navlakhi, thank you so much for joining us today on ET Now. So to start with, Mr. Navlakhi, let's understand the profile of a retiree. This is an individual who, of course, does not have, a 9-to-5 job or a business essentially from where he or she can earn their profits or, get their monthly, expenses catered to. So what is the profile, Mr. Navlakhi, of a retiree? How do they sort of cater to their expenses? For all the viewers watching who are not yet retired, what should they sort of brace themselves for from a financial perspective?
Yeah, thanks, Mubina. I think this is a really, really hot topic today, because in the last few months, we have seen interest rates fall in every single category, whether it is savings bank, whether it is fixed deposits, and even in liquid funds that people were used to investing in, interest rates have been falling. And the worry for anyone who is, approaching retirement or has just got into retirement in a scenario like this is that if they are used to, let's say, getting 6% or 7% of interest from their fixed deposit type of investment, if that has dropped now to 5 or 5.5%, the worry is that over time, will this interest rate keep going down? And if it keeps going down, how are these individuals to manage their cash flow requirements during retirement? Because the important thing that we have to keep in mind for someone retiring is that they do not have additional funds available to invest or to top up or take advantage of market situations to make up for any loss of earnings that might happen. And therefore, especially for those who just sort of get into retirement around times like this, there is a very high level of anxiety, because if you sort of extrapolate the trends that have happened in the last 1 year, then you worry, okay, in the next 20-30 years of your retired life, how is this going to get managed if interest rates really were to fall? So I think the way to look at this for retired people or people getting into retirement is that remember that retirement period that you need to take care of or cater to is going to be relatively long. Life expectancy is certainly moved up, and with nuclear families, you really need to fend for yourself in your retirement and fend for yourself over longer periods of time. So it's important not to treat the entire corpus that you have as one sort of bundle, but break it down into smaller pieces which are easily sort of manageable. First and foremost, take care of the first 1 or 2 years requirement and keep that in very, very safe sort of investment options. So you could just leave it in your bank, put it in a 1 year fixed deposit, or leave it in liquid or arbitrage mutual funds. Now, remember that in this category, it is not so very important to get a high rate of return. The most important requirement in this category is to have liquidity. After that, when I think of requirements over the next 3 to 5 years, then I can start looking at debt mutual funds or balanced mutual fund or the hybrid mutual fund category, which is relatively the uh, less risky in the sense that take the hybrid categories which are conservative, which have only maybe 15, 20, or the most 30% allocated to equity, along with debt mutual funds. Because in debt mutual funds, you can invest for 3 years, it will be long term, and therefore you can then use the money. And then beyond 5 years, I would think that investors need to look at their risk profile. Beyond 5 years, look at, if you are comfortable in terms of taking risk to the extent of one third of your portfolio, then the balance portion, after you've taken out the 1 to 2 year requirements and the 3 to 5 year requirements, allocated based on that. So one third of the balance can then go and be invested with your risk profile in mind, and therefore have an element of equity there. I think that's the first thing that the investor needs to do. And I know that there are people who will say, I'm also getting a pension plan or I'm getting rental income, it's already taken care of. We'll worry about all that later. First, break this up so that your liquidity and your short term requirements are very safe. It will allow you time to settle into your retirement, and then you start feeling more confident about some of the equity investments that you made with a 5 year plus outlook.
Okay, so yes, the retirement period is definitely going to be long. Life expectancy has increased, and as we always say, a child is not your retirement plan. So you've got to be sort of you have to understand that financially you'll have to be independent when you retire. And since the period is going to be long, Mr. Navlakhi advises you should break it up into 2 or 3 portions. So the first portion, which will be the first 1 or 2 years, keep it in extremely safe investment options. So a liquid fund or a bank FD, something that's very, very liquid and safe. And by then you'll just sort of be settling into your retired life. So it'll give you an idea of what to expect as well in terms of your own habits, in a way, because money has a lot to do with your own psyche and your habits as well. So keep it in a safe liquid option. Then maybe the next 5-6 odd years or 3-6 odd years, you can look at debt funds, hybrid funds, etc. And then beyond that, you look at your own risk profile, your attitude towards risk. Do you not want that extra risk, and you don't want to invest in the equity parts of it, you want to play it safe, then you can sort of play it safe. But yes, do remember that we are living in this low interest rate environment kind of a thing. So it's something that you'll have to be prepared for and live with. But yeah, if you break up your entire retirement period in this manner, then it will sort of help you tide over it as well in a very easy fashion. So Mr. Navlakhi, let's say I've passed those 1-2 years and I've put my money in a basic bank FD and a liquid fund, which I think most of our viewers are obviously very familiar with. A bank FD or savings account, they're very familiar with. How do you recommend they enter that next period, that debt funds, hybrid funds? How do you sort of split it up? What would be your ideal split?
So as I mentioned, I think that if I'm very close to retirement or I've just retired, then the first 3 to 5 year requirement, I choose debt funds. I choose the conservative hybrid funds. If at all I'm comfortable with really top class AAA type of corporate deposits, then that's the third thing that maybe I could allocate to. Now, in the case of debt funds, we know that during 2020, we've had some scare in some debt fund categories. So it is important that if you have a good advisor that you are working with and who can sort of guide you in terms of what type of debt funds to invest in, that's one way of going about doing it. If you do not have an advisor and you're trying to do it yourself, then I don't think you need to look at and see the past performance and then decide investing, because debt investing in debt funds does not happen that way. It's very important to look at what is the composition of those debt funds. If you don't have an advisor, maybe you don't even get into the debt fund category. In the hybrid category, there are conservative hybrid funds. They are typically come with the name equity savings, where they could have between 15 to 25% in equity and the rest in debt. Then those are some of those sort of schemes that you could invest in. And if you go beyond that period, Mubina, that I'm now looking at beyond that 3 year period, 5 year period, and as I mentioned, look at your risk profile. When I look at my risk profile and I find what's the component I want to put into equity, the balance portion again still has to go into investments which hopefully will beat inflation and give me a rate which is slightly better than inflation. Now, some of the things that people could look at the government sort of promoted schemes, such as the senior citizen savings scheme, which is available for just 5 years. So now again, if I'm going to invest with a longer term outlook, at the end of 5 years, I'll have to renew that amount, and then I have to always worry with what will be the interest rate when that amount matures. If I have a 10-year time horizon, then I can invest in the Pradhan Mantri Vaya Vandana Yojana. Gives me a similar rate at the moment as the 5 year senior citizen product, which is right now 7.4%, but government keeps sort of revising this every quarter. So I can get 7.4%, again taxable. Again, the limits are there where I can put only about 15 lakhs in either of these categories. Once I cross the 10-year period, there is a public provident fund account where I can put in 1.5 lakh rupees every year, but I can extend that scheme from the first 15 years to every 5 year sort of tranche and continue investing. PPF is giving me a slightly lower return today of 7.1%. But these are things where I'll try and put in money where I'm trying to get some return which is higher than my bank FD rate and locked in today because I expect interest rates to go down. One of the other schemes that people were sort of looking at investing through would be a typical pension plan or an annuity plan where you're getting some return from the investments that you've put in and which have accumulated, and you're using that in your retirement to get cash flow out of it. The issue over there is that the annuity portion is taxable. So that was one worry. Many insurance companies have come up with bundled sort of insurance plans, come annuity plans, which if you are at least 5 to 10 years away from your retirement, they are good products to get into today, where you put in money for 5 years or 10 years. So there's an equal amount that you put in for the first 5 or 10 years. You get a life cover in that period. And because it's a life insurance product, at the end of the 5th year or the end of the 10th year, you can start then getting cash flow, an annuity. And because there was a life cover associated with that product in the first 5 years, all the returns are tax free for the next 30 years or 35 years. And although that return is today available, those products are available with returns of approximately 5.25% post tax. They are extremely attractive from the point of view of your sort of worry that interest rates could go down. So if they do actually go down, you have locked in at a slightly higher rate. Similar to what there was an opportunity 2 3 years ago of investing in tax-free bonds, where you got 8% tax-free for 10, 15, 20 years. If you locked into that, great, because today the same tax-free bond is available at under 5% tax-free. So there are a few things, nuances that you'll need to keep, your eyes and ears open on, and forget what has happened in the past, because India is going through a very different interest rate scenario as we move forward, and therefore you do expect that interest rates will be lower. So the earlier you can lock into higher interest rates, the better it would be.
All right. Okay. Well, that of course is Lovaii Navlakhi's recommendations when it comes to investing and how retirees can essentially manage their money amidst this relatively lower interest rate environment. Okay, well, we've received quite a few questions and queries as well, Mr. Navlakhi, from our viewers who are on the verge of retirement or have already retired. We have Subramaniam Pichai saying, if inflation stays around 7%, incidentally, in just a couple of minutes from now, we'll have the CPI number as well hitting our screens. Anyway, as inflation stays around 7%, how should one go about how the one who is going to retire in 1 or 2 years allocate a corpus, say of 1 crore rupees, among debt for regular monthly income of 25,000 rupees and the rest of the money in which mutual funds, so that they can return through an SWP after 10 years, so that one can get regular income for another 30 years. So his bid seems to be pretty straightforward. He has 1 crore rupees. He wants monthly income of 25,000 rupees for the first 10 years. Then he wants an SWP after 10 years for 30 years. So I think largely I believe he may have already drawn some inspiration, Mr. Navlakhi, from what you've just told us. But how do you recommend Mr. Pichai go about distributing his funds?
Yeah, so one of the calculations that I did for this question is that if you require 25,000 rupees a month and you have 1 crore of rupees available today, and as you mentioned, you are retiring in a year or two, what it tells me is that the 1 crore is enough for 25,000 rupees for the next 30 years, provided you get 1% over inflation right through this period. If you manage 3% over inflation, then you only need 75 lakhs. So to that extent, there is some buffer available for you. It is quite possible through, some careful planning to try and ensure that you get that 1 to 3% over inflation. And that doesn't mean that you're taking too much risk. I suppose the way forward for you is to see if you can lock into, since you have a couple of years left yet for retirement, to see whether you can lock into any of these interest products with fixed return products for the next 25-30 years, which is your requirement, even let's say to the extent of say 10,000 rupees. So partially you're fulfilling that through that product. The other part, then you can follow some of the suggestions that we have made earlier in the show of splitting the requirement for the next 1 to 2 years in safe liquid instrument, then going to debt funds, and then looking at your risk profile and investing in equity funds or RBI bonds or annuity plans or the senior citizen schemes and so on and so forth.
Great. Well, unfortunately, that's all the time we're going to have. We'll not be able to take on board some more questions. But Mr. Navlakhi, thank you so much. It's always a pleasure, having you on the Money Show and break down some very simple concepts of investing and financial planning for our viewers. All right, well, it's time for a very short break. If we have not been able to, of course, take your question and query, you can always write into us on the Money Show at etnow.tv, and we'll be sure to take your query over the course of the next few days. For now, quick break.